Now we move on to the next part of our program. The next part of our program is a panel discussion. Can I have these chairs moved a bit forward, please? The panel discussion is on improving interlinkages of Indian financial markets with global markets. As Mr. Subramaniam sir said, they have Reserve Bank of India itself has taken several steps to try and improve this. And this is something that is very much a need of the present by Indian banking. And we need to try and see how best we can do this and improve it. So we have a 5-member panel. I will be calling the names of the panelists and I would request them to come here and be on the dais. And this is just in the alphabetical form of the bank names. So first and foremost, Mr. Jayesh Mehta. Mr. Jayesh Mehta, Managing Director, Country Treasurer, India, Bank of America. Briefly, Mr. Jayesh Mehta is the Managing Director and Country Treasurer for Bank of America, India, and heads the fixed income, currencies, and commodities business for the Bank of America in India. He was chairman of PDAI, Primary Dealers Association of India, and also vice chairman of fixed income FIMDA, which is Fixed Income Money Market and Derivatives Association of India. He was a member of Reserve Bank of India's Technical Advisory Committee for Money, Forex, and Government Service Securities. He was also a member of a subgroup of the Financial Sector Legislative Reforms Commission and is currently a member of various regulatory committees. So welcome, Mr. Deshmukh. Next, I invite Mrs. Anita Mishra, Managing Director, Head of Markets and Security Services, India, HSBC, India. Anita Mishra heads the Market and Security Services business for HSBC India, overseeing the firm's activity in FICC equities and custody clearing. She has 20 years of experience in global markets across fixed income, currencies and commodities and capital markets. She started her career in India global markets in 2000 before joining HSBC in Hong Kong in 2010. In the last 12 years, Anita has donned multiple hats across regional sales and solutions in the Hong Kong trading floor. And for the last 4 years was part of the capital finance and investment banking coverage team. She has an MBA from the IIM Calcutta and a master's in finance from London Business School. Just a few things on her hobbies, which I found interesting. She enjoys dabbling into wildlife photography, adventure traveling, weightlifting, and baking, and has a passion for conservation of the environment. She's involved in several groups involved in conservation of the environment. So welcome, ma'am. Next, can I invite Mr. Saurabh Nath, General Manager, FMOD from Reserve Bank of India. Mr. Nath is a General Manager and Chief Dealer in RBI's Financial Markets Operations Department. His experience also includes exposure to areas related to foreign exchange management, public accounts, and currency management in RBI's regional offices of Mumbai, Kolkata, and Bhubaneswar. He was also deputed as a member of faculty at Reserve Bank Staff College, Chennai. He's done his master's in economics from Delhi School of Economics and an MSc in finance from Durham University Business School, UK, on Reserve Bank scholarship. So welcome, Mr. Nath. Next, I invite Mr. Rajay Kumar Sinha, Chief General Manager, Global Markets, State Bank of India. Of course, he's Chairman Fedai, but I'm inviting more as Chief General Manager, Global Markets, State Bank of India. He's a Chief CGM at State Bank of India Corporate Center, Mumbai. He oversees treasury operations of the bank. In his various assignments in the bank, he has managed the financial institution relationship, treasury operations, and ALM of SBI's overseas operation. He has worked extensively in major banking verticals like treasury, international banking, and retail banking, including overseas assignments at SBI London. So welcome, Mr. Sinha. And then the moderator for the group, Mr. Paresh Hede, market leader, sales and account management, South Asia, Refinitiv, and LSAG business. He comes with more than 20 years experience in financial markets and related technology and is currently the market leader, sales and account management at Refinitiv, now a part of LSEG. He currently looks after strategic accounts, including large Indian and foreign banks, large broking firms and exchanges. Prior to his current role, he was the director enterprise solutions for Thomson Reuters for South Asia region. He has extensive background in technology as well as being a CTO and successfully handled acquisition of technology companies by Thomson Reuters. He is the architect behind rolling out Thomson Reuters' highly successful next generation electron data service in South Asia in 2011. Welcome, Mr. Paresh. Uh, so after, of course, you will carry on with the panel discussion, and then we have an interaction question and answer session also. So you will remain there. Just before I hand over to Paresh, there was a small announcement which Refinitiv had requested me to make, which I didn't make, which is that those of you, if any of you have not yet answered the questionnaire that they have out there, please do that, because that is going to be the basis on which a lucky draw is going to be taken. Also, if you have not dropped your visiting card in the bowl in State Bank of India's this thing, please do that now, because that's going to, I don't want to disclose, but yes, that's going to be something that can give you an incentive. So please do so if you haven't done it. That's all. Thank you very much, and over to you, Parish.
Thank you, Mr. Pradhan, for the introduction. And it's a great pleasure for me to be here, moderating such an august panel in this Fedai event. Let me start by, I think Mr. Subramaniam actually set the tone for today's conference. And, the Indian economy over the last 2 decades has grown significantly. We are the 5th largest economy in the world. We have a very robust and deep stock market, which is one of the 10 largest in the world. Very few people know this, but we are the largest futures market in the world. So all things going for the country. So I think it's the right time for us to discuss this, the topic being interlinkages between the Indian financial markets and its global counterpart. So I'm going to put the RBI on a little bit of a spot here. And I think Mr. Subramaniam actually has taken a little bit of a thunder from our panel discussion today, I think, with his comments in the morning. But I think the operative word for today is principle-based regulation. So Mr. Nath, I would like to ask you, can you sort of elaborate a little bit more on principle-based regulation and what has been the focus and objectives of RBI's regulation to sort of clear hurdles for us to be part of the global financial markets? Thank you.
Yeah. So very good morning and warm regards to all of you. Now, the Reserve Bank's financial market regulations, they have always aimed to put in place a robust market microstructure so as to foster enhanced market transparency, market access, and price discovery. Now, in the recent years, in fact, the buzzword has been, in fact, the guiding philosophy for our forex market regulation has been that any person who wants to access our markets must be able to do so with maximum ease and minimum cost. And this is being done through what we refer to as principle-based regulation, as against rule-based regulation. Under principle-based regulation, the detailed procedural prescriptions are done away with, and it is replaced, and these prescriptions are replaced with broad and basic guidelines, which gives a lot of flexibility to the market makers. I will give 2 examples. First, we know as a principle that for market access, one needs to have underlying exposure. For underlying exposure, earlier a lot of prescriptions were there regarding hedging. Now, all those prescriptions regarding hedging have been done away with. And second example, which is perhaps in sync with the theme of this panel, is the removal of restrictions based on residency. So this brings non-residents at par with residents regarding market access, market entry or exit. So So this is the way I basically explain the buzzword for today.
Thank you, Mr. Nath. So with that, coming to you, Jayesh, I mean, as RBI explained, right, it's been very forthcoming in terms of regulations, etc., principles-based regulations. Where do you see us today from a market infrastructure perspective? How linked are we in the global economy? How easy is it compared to, say, let's say 5 years back? What's your view with your vast experience? I think this is switch on, yeah.
Hi, thanks, Paresh. I think that's a multiple fold of questions in it. So let me break it up into 2-3 parts, and then of course detailing we can go into it. So one is of course if you look at financial markets, so we are not restricting only to RBI. So if you really look at our equity market, had a head start. There was a little bit restriction here because we are not fully convertible currency as of right now. So that always will be the little bit of restriction there. But even with that, I think in recent past, we have opened up, as Mr. Nath said, on allowing the global parents also to directly hedge here, manage the FX directly here. So that's one part which is kind of globalizing it, with restriction, of course, because we are not a fully convertible currency. Of course, NDF was a big move, which was to actually getting streamlined, aligned. Again, at some point of time, we will have deliverables also, but when we become fully convertible. So at this juncture, it is only restricted to non-deliverables, with of course restriction with YFC. So that's definitely done. One more step which is announced is NDOIS, which is also kind of linking it. I think the big step which is really missing out is on the government bond side at this juncture. And from RBI side, we are doing everything possible. But it is maybe, as I said, some of the things now we'll have to use like Modi ji's international relationship, because I think it's chicken and egg, right? So people won't really come till you get into index, and the index guys, somehow fixed income. Maybe Anita would have different view on the thing, but my view is globally fixed income guys are still very traditional thing, right? So you go to New York trading floor, you'll still find HP calculator on their desk. So they have this nostalgia kind of thing. And that's where one of this requirement of Euro clear, which I personally think, maybe I'm happy to get corrected, I personally think it's not really required. Like you look at our equity market, it is there on indexes of MSCI, which is the largest emerging market index, but they are not getting cleared internationally, they're getting cleared here. Maybe 15, 20 years back, it was a different situations. Every country had different regulations. Your global transfers were difficult. All that is great. If you look at our settlement system, we are the world-class settlement system, right? In fact, I keep on pushing CCR. They should market their settlement system to the international guys too. So that, having done that, plus if you go through the Euro clear only, the investors actually get access to maybe 10, 15 authorized dealers. When they access Indian market, they get access to the whole set of people like provident fund, mutual funds, insurance companies, banks. So from that perspective, I am still baffled as to why they are insisting on Euroclear, and that's where I think that's one step which is missing. I think we did FAR, which is on the government securities. So there is no limits we have kept. So I think that's something we need to work on. So that's missing piece, but otherwise, yeah, we are moving slowly towards that.
Sure. Thanks, Jayesh. And I think thanks for bringing up the bond indices stuff, because I think we probably have more to discuss on that. I'll come to you, Mr. Sinana. And before I come to you, some trivia. So just last week, I think SBI celebrated the 100th year of its presence in the UK. So congratulations on that. And its 25th year of listing on the London Stock Exchange, which is our parent company. So I think, yes. So it was quite interesting to see that. So you talked about market behaved very rationally during one of the biggest, not just the pandemic, but the event of the century, if I may say, from all perspective, but obviously from financial markets. And so do you also feel that because of whatever we've done so far, we were able to manage this in a much better way? And your thoughts
Thanks, Paresh. If we look at the last 2 years, especially after onset of COVID, we already know that market behaved very responsibly. Look at the way equity markets behaved, GSEC market, and of course, foreign exchange market, with support from everyone, policymakers, Reserve Bank of India, and market participants. Absolutely fantastic job. I'll give you 2-3 examples of that. During these 2 years, it was so easy for the market to panic at any point in time. Just look at what happened in 2013 and what happened in 2008. And in that context, I'll give you a couple of examples. When in March, the equity market tanked, we were worried about, we were thinking about 2013 and how will it affect the other markets, but it recovered quickly, sharply, and I believe that markets did not panic. At one point in time, SBI credit spread was, I think, 750 or something. Just imagine, global markets I'm talking about. But market immediately recovered, and rupee recovered, of course, with support from all the stakeholders, including the RBI, who always keeps to our help in such crisis situation. That is one. Second, when export orders started getting cancelled because of logistics related issue in maybe late March and early April, we were again quite worried, all of us. Remember what happened when last time export orders started getting cancelled like this? That was 2008-9. And many people actually went bankrupt. We suffered, all of us suffered. But the way Forex market again did not panic, gave us support, confidence at 2 levels. One, market is more mature. Second, in derivatives, at least, what we are doing right now, it's much better than possibly what we did possibly 10, 15, 20 years. So that is second. Third part, if you look at it, food grain prices started rising some, I think around September 2001, commodity, what we call super cycle. I don't know whether it's super cycle or not. It all started happening around that level, and freight prices actually skyrocketed. Every region why Forex market should react and should have reacted actually. So in that sense, everyone talked to the other counterparts. In case of exporters, we did whatever we could do. All the banks and of course government and Reserve Bank of India, we did whatever we could do to ensure that the impact, it's limited to cancellation aspect. It does not spill over to other markets. Food grains, again, all the regions why rupee should react, commodities, freight, despite everything. And as I said, there were provocations all along over the last 2 years, but we stuck together, and we, I believe, market and the policymakers committed to keep it, anchored, and that is what happened. So in that sense, market did exceedingly well. And that is a great learning experience coming out of this this period, 2 years, without any significant dent in any of the market, honestly speaking. It's incredible. So that is what exactly I meant when I said that market behaved responsibly. Thank you.
Thank you, Mr. Sinha. I think that's absolutely the thing. I'm coming to you, Anita. First of all, welcome back to India. I think you've just come back in December. You've been in Hong Kong for 12 years, one of the most open markets, a financial market hub by itself. And now you're in India, and we're talking about interlinkages. Where do you see, how far have we gone? And, where do you see us in terms of, what you've seen in Hong Kong versus what you see in India?
Thanks, Paresh, and thank you for the welcome. It's actually great to be back, and great to be back at a time when you see all engines of a country firing. And so to me, first of all, to answer the first part of your question, it's indeed a very different financial landscape and a regulatory landscape that I've come to than when I was last here, and seeing the kind of broad linkages, right? So financial linkages are a function of 3 main activities, right? Trade, then capital, and then finally wealth, right? Yeah. And this is usually the sequence in which these 3 activities kind of unfold and grow in most countries, right? As they move through regulations and through opening up. Trade itself has, gone through 10 to 12 times in terms of, volume and in terms of activity, in terms of corridors, in terms of currencies of settlement. And, if you look at the number of nostros, et cetera, that you're dealing through, so these are just simple data points in terms of the growth that we've seen. In terms of capital, except for, a full capital account convertibility, we've come through a lot, in terms of foreign money coming in through, whether it's FPI, whether it is FDI, or overseas direct investment, etc. So the 2 weeks kind of a thing, the LRS scheme that has been folded through. So that's come along very, very nicely and this thing, right? And then finally in wealth, right? Again, we're seeing that wealth story develop and shape up today, for this country. We're seeing AIFs coming through. We are seeing, a lot of options in terms of investment for the average individual that weren't existing, right? So where do I see this in comparison to a market like Hong Kong, which really has been one of the 2 financial hubs for Asia, and indeed one of the top 3 financial hubs globally, is that I really don't think we have that much gap when I think of trade. I think when I think of capital, I think we are 70-80% there. There's some more to do, capital convertibility, etc. There's there's an attraction of a hub like Hong Kong, obviously coming in from the part that it is a financial hub, coming from taxation, coming that a lot of banks and financial institutes have head offices there, or one of the 2 head offices in Asia there. I think we probably have some steps to go through in wealth. So today you can see, a retail investor in China going and accessing any exchange around the world and being able to, say buy Tesla, something, right? I think we are making steps toward that. So what you see with GIFT, and when you see with the DRs that are going to be listed there, etc., and with what you see, I think it's happening in the right pace, in a pace where we carry the regulations, we carry a market access regulations and the kind of a financial balance together. So that's it. In terms of many of the Asian countries in South Asia and ASEAN, I wouldn't even want to compare, because I think we've taken over them, in all these 3 aspects.
Fantastic. It's great to hear that you're saying we are very, very much close to what Hong Kong has achieved. But and also you mentioned about equity markets and about Indians accessing, right? I mean, just a fact, about just last year, about 200% increase in the number of US stocks that Indian retail investors bought. So I think we're getting there in some shape and form. So I'm going to come back to you in terms of if you could sort of give a little bit of more detail and color onto some of these policies and regulations that the RBI sort of come out with, which have sort of facilitated the position that we are in today in terms of interlinkages.
Start with some of the Forex measures which we have taken. One measure which is often much talked about is since June 2020, Indian banks having IBUs, they are allowed to offer non-deliverable derivative contracts to non-residents. So this basically removes the segmentation between offshore and onshore, and by design reduces volatility and cost of hedging. Also, we have the move towards 24/5 market. So Indian banks, they are allowed to offer quotes to their clients, both residents as well as non-residents, beyond market hours from their books in India. Also, exchanges and banking units in GIFT City, they are allowed to offer foreign dollar settled rupee derivatives. Also, there was one measure where there are some non-resident entities who are, by structural or behavioral reasons, not able to access onshore banks. They also have been allowed to access onshore banks indirectly they are allowed to continue transacting with their offshore banks of their convenience, but that offshore bank in turn can seek quotes and take cover from the onshore bank. So these are measures. Also, Indian banks are allowed to place margins in overseas. These are some measures in foreign exchange. In interest rate derivatives market also, we have that FCS OIS thing recently. And also earlier, overseas entities, they were allowed to participate in OIS markets for purposes other than hedging. FPIs, they are allowed to participate in interest rate futures. Something. Now in the bond market, FPIs, they are allowed to access government securities. They have 3 routes now, medium-term framework. This was since October 2015. Then voluntary retention route. And then recently, in fact, 2020, April 2020, I think. So this was FAR. And FAR is being taken, in fact, FAR is being seen as a step towards basically, in fact, global inclusion in global bond indices. In fact, once that thing comes, FAR is seen to be basically promoting that towards a move towards that. But again, global bond index inclusion is a work in progress. But enablers are in place. We have done that. And regarding other markets, these are some of the measures I can think of.
Sure, sir. So thank you very much. And I think Mr. Subramanian also talked about the fact that how the RBI also looks at the government vision in terms of gift, etc. So Jayesh, I have a question for you on this whole FCS OIS trade and this whole, interest rate futures, this from a from a international center perspective. Where do you think, how is that an enabler? Is that sort of getting enough attention now that both the government and the regulator are sort of, pushing people in that direction?
The NDF and IFP unit, right? So that's really helped. If you really look at it, there were linkages from the NDF market and the onshore market. But yeah, there were not direct linkages. Some indirect linkages were there. Now we have actually made it pure, officially open linkages, so that with this we have the control. We can see what is happening, and that's really helped narrowing the bid-offer spreads, both onshore, offshore, everywhere, right? So it is really worked very well. And of course, as I said, like, yeah, as of right now, it's only through the offshore branch, but at some point of time, we can do it like OIS on the onshore branch too. But as of right now, so that's worked well. Again, expecting people to move out from Singapore, Hong Kong to here, it is gonna take a long time. So this is more like, disseminating the onshore price linkage to offshore, or the offshore price linkage to onshore. So that maybe the market makers there can actually use one of the IFC bank branch to actually, get the access to onshore or vice versa. So that's one thing which has happened. On the NDOIS side, it just announced right now, and we need to work on it. And I think that will also bring a pretty good linkage on the rate side. Hopefully, like, as the intention is to bring all the rupee interest rate to India, and that's the kind of deepening it. So from that perspective, I feel from a regulatory side, we are doing, given that we are not convertible, we are doing whatever best we can on a slower basis, but we are doing it. But I think a couple of things which is required is particularly on the collaterals, particularly on the new, we have to see how it will work. So that's on the NDOIS side. NDF side, it's an offshore unit, so there's no such question. It's like any branch in Singapore or Hong Kong or anything else.
Sure. Anita, my next question to you on NDFs to GIFT. I think one of the reasons for GIFT was that we wanted to move the NDF trade within the country, right? Is that happening slowly but surely, and how long are we in terms of getting there?
Yeah, so obviously, I mean, the NDF volumes in GIFT have gone through the roof, as has been acknowledged by Mr. Subramanian, and
yeah.
I think most of you know that here. And as he rightfully said, 99% of that, and really 99% of the NDF volumes that you're seen within the geographical parameters of perimeter of India has really been interbank and not client thing, right? But as Jayesh said, that the one effect, immediate effect, has been the the difference between the onshore and offshore curves has come down significantly, right? So where do we go from here next, right? Now, go to the next level where you're actually attracting the offshore client and the offshore customer to start dealing either in the IBU or in the banks in the, in the India onshore market on NDF who have license in IBU. For that to happen, it's not just a function of easing regulations here or making markets access. It's the entire ecosystem that they get in Singapore, Hong Kong, right? So for example, a hedge fund that's accessing NDF there today has a multi-branch dollar CSA, and has a number of asset classes, and a huge netting ability for collateral facing, say, an HSBC Singapore or HSBC London, right? That is not going to be easy to unravel, I think, and that is what will take time as we go through. And really, I think as we open up, I think my own belief is that we will also, as an economy and as a financial market, learn some things. And one of those things could be that it's not important to get the customer into the geographical perimeter of India, but what is important is to make these markets fungible, make these markets transparent, allow the kind of market access, have taxation as a leveler and not as a point of arbitrage, for example, and then let market takes its own course and let the clients take its own course.
Sure. Thank you, Anita. Coming to you, Mr. Sinha, you talked about 24/5 banking, more IBUs to be opened, etc. Do you see that that's helping in terms of increasing the volumes, giving better access to banks? Because Mr. Subramanian also talked about the fact that in the FCS OIS trade, there's only about 18 it's just announced 18 banks have become participants. Do you see that sort of going to the roof because of the fact that we are sort of giving more access to banks and the customers?
We have seen the benefits in NDF space at least. And while I agree that a very small proportion is with the clients, the fact that it is very close to eliminating the arbitrage between the onshore and offshore market. It's not just about supporting the clients or any individual group. One of the reason behind NDDCs and now NDOs is to have a better monitoring and control of offshore market, and that is already happening. NDF volume will only go up. NDOIS has been announced recently. Look, once the market start doing it, they do not. Market participants sitting here do not differentiate between NDF and deliverable. I'm telling you, they will not differentiate between NDOIS and OIS. Whatever suits them, they will do. So it's definitely helping already. In case of NDF, definitely NDOIS will take some time. OIS, it's not that many corporates and end users are using it in any case. So these things are helping. Extended business hour, for example, for non-deliverables definitely helps us. If we go to IFSCA part, IFSCA has been very active, the administration. Some of the activities undertaken by them supports that again. And if, as Mr. Jaina promised, we get NDF settlement where banks have to post collateral in rupee, it will tremendously help for the simple reason that many smaller banks do not have capabilities to post dollar collateral. So all those will come. So all these steps are definitely helping it. And onshoring, offshoring is a different issue. After a point, I think none of these people will differentiate between what is onshore, what is offshore. I think in the rupee NDF space, they are already not differentiating. So, yeah.
Okay, thank you, sir. Looks like we are in a good place. The one thing that you guys talked about was convertibility, but we'll not use that as a part of our discussion today. But I think there are some systemic issues that we still need to get past. There was a big discussion before on KYC, which I think didn't conclude. So do you think, Jayesh, getting a true and true KYC is something that needs to be addressed, especially, because we have such a robust KYC mechanism from a CKYC perspective, from a Indian capital markets perspective or this thing, etc. So is that something that is warranted?
Good you asked that. There's something very passionate about. So I think one of the thing, as I said, like why Euroclear, right? Apart from being nostalgia, it's the pain on the KYC, right? So people don't want to really go through the Indian KYC, and there is a history to it, right? Our FPI regulations and all that has been all generated from the equity side of it, right? If you look at some of the regulation and some of the form, you will realize that this is still the equity kind of mindset which is there. And that's where it is coming off, is on the round tripping side of it. So of course, KYC is globally challenged everywhere, but we have extra challenge because, we had this mindset of equity. And in equity, we look at the round tripping situation, right? So yes, on equity, round tripping does matter because the same money coming back into the company, pumping up the shares and other things. But, if you do it for government bond or state government bond, how does it matter, right? So it's money, whether it is round tripping or if it is, it's good that it's not going to some other country or so it's coming back to India as long as it's coming in government security. And nobody can manipulate government securities markets. So that relaxation, we should look at it. Particularly because that's a big one. Because just to give you an example, in equity or today in the FPI regulation, if a fund like today, if I deal with HDFC mutual fund in India, you issue just one contract, right? But if it is an international fund which has 10 scheme and is buying in 10 scheme, you have to have 10 different registration, 10 different transaction to be done. And that's because each and every scheme has to be, regulated for round tripping. So that's one part of it. And secondly, of course, I'm not saying do away with taxation, have some direct taxation, maybe withholding kind of tax or something. But telling every investor want to trade in India to have a PAN card is also very challenging. And that's the reason, people are kind of asking about the Euroclear requirement. So I think once we ease that, I think that could become much easier.
Sure. Anita, my question to you and Jayesh brought this up before, there was a buzz about India being included in the global indices, bond indices. That's taken a little bit of a back step right now, especially after the budget, the taxation side, things on Euroclear. I know, again, a favorite topic of yours, but what's your view? Is it because a wall of money was expected to come as part of the inclusions? It's not that we're not including, but it's going to take some little bit of time now. What's your view on this?
Yeah, so I think needless to say, it's probably the most anticipated new thing in our markets that people would look at that would make a material difference. If you're talking, not one or two, but 10, $20 billion, you're looking at, hundreds of passive accounts around the world, and this thing, it's a very big step. It's something the market's really anticipating. It is going to take our bond markets into a different league altogether. Interesting. I do think that it is not easy for the government to have one set of taxation approach when you're looking at bond indices, and that completely contradicts its position with certain other negotiations that they are having, or the way an average individual onshore investor in India is today taxed on government bonds, right? So we cannot have that. And Jayesh brought this point on earlier on, do we really need Euroclear or not, right? And this is probably a pertinent question that we will need to go through at some point again, I believe, is because there are markets in again, Asia, I think Indonesia or Thailand, or I think two of Indonesia, Thailand, Malaysia, I forget which ones, but they don't use Euroclear at all, right? But then how do we do KYC, right? So again, that's the thing, is that, so the balancing between the KYC and having, again, a smooth tax regime. I mean, one thing we need to understand that what the government vision, or, even from the central bank, maybe Mr. Nath can add, is really to not have these kind of lumps on taxation that, you have an arbitrage here, you have something that's, saying it needs to be more of a lever in the medium term. So to that extent, if we have to wait another year for it, I think it will still remain one of the biggest thing that happens to our markets.
Sure, thanks. Mrs. Sinha, your comments on this before I ask if Mr. Nathan wants to comment, especially on the non-inclusion in the global bond indices.
So much discussed already. We all will like to have that. But honestly speaking, I'm always bullish even otherwise on rates market. So it's a temporary setback. If it comes early, wonderful. Otherwise, also we will survive. 30 billion, 40 billion are all numbers that we have done on the back of the envelope. How much will come, we don't really know. So, selling short fixed income securities only because this is not happening. I cannot afford with a 14 or 15 trillion rupee investment portfolio. I cannot afford to remain bearish on interest rate markets. But that is something we all are eagerly waiting for, especially in a situation like this. For example, this year's government borrowing 14.95 trillion. We would have liked that enabler to be in place, but I think we would survive. Thank you.
Mr. Nath?
I believe that index inclusion is a call which indexes have to take. So, but again, from RBI side, as I said earlier also, like we have we have done FAR, fully accessible route, and which was done as with a view towards index inclusion. So we are all waiting for it.
Okay. Mr. Sinha, I had one more question on some challenges. I mean, do you see how can we sort of increase participations to bid-sized and smaller banks? Because India is a large banking market. How do they sort of participate in this entire, ecosystem in a better way from a globalization perspective? Is that a challenge? Do you think that there's enough being done there?
It's a challenge. It's a challenge, definitely. And it's more like the challenge of infrastructure. As I mentioned in that particular context also, many of these banks, smaller banks, do not see any value actually in, doing a whole lot of transactions only to post collateral. So they do not have dollar collateral. They may or may not have dollar assets. So they cannot post dollar collateral. Posting cash dollar is a problem. So CCIL's guaranteed settlement, it's going to be, in my opinion, a game changer because it will bring in many smaller banks to NDF space. We can think of tri-party repo collateral management system in India, institutions, possibly CCI can think of it or some other organization, tri-party collateral, things like that. I mean, we already have a very robust payment and settlement system. Can we extend it to IFSC? More importantly, we would like to have interoperability with the leading clearing and settlement system across the world. It has to be a very smooth, transaction. Similarly, trans-border, can we bring the, pain points down to a minimum? So these are the issues that will help the banks. From regulation point of view, integration, a high level of integration is already in place, as we have already discussed here. Look, when we talk about on trading, rupee is convertible. Remittances, inward remittances, it's definitely convertible. Outward, it's a challenge slightly beyond LRS. But if you think of capital account convertibility, there are 2-3 parameters actually. Are we allowed to borrow? Generally speaking, yes. Are we allowed to do the debt servicing? Yes. Are we allowed to repatriate the fund? Yes. We are convertible on capital account, 80%, 90%, doesn't really matter. Other issues are essentially operational. LRS limit can be increased from 250 to 1 billion, or can we do away with it? It will help. Can we allow residents to directly participate in growth opportunities abroad? We have allowed it through IFSCA to some extent. We can actually further relax it. These are operational issues. At policy level, I don't think there is any major challenge. So KYC, etc. These are irritants. I mean, if an entity is a regulated entity in a FATF compliant economy, jurisdiction, why should have an elaborate KYC for that, separately? But think of it. For example, IFSC has recently permitted NLT. Now, if somebody wants to transfer, I guess, its entire derivative portfolio from Mumbai to IFSC, it should be okay. If we get the arbitration, this thing as promised by the FM in the budget, it will be an absolute game changer. So there are so many things that we can do, but it's a process that has started. It's not a reversible process.
Sure.
Thank you.
Thank you. Jayesh and Anita, question both to you and probably also to Mr. Sinha. We talked about, while we had the worst pandemic, the market behaved itself. I think we are now looking at a slightly different scenario in the last 3 weeks or so, which is geopolitical risk, inflation, some call it stagflation, oil prices, all of that sort of things. Do you think we will be behaved still in this scenario because of all the, all the framework that has already been put in? Are the markets going to be, okay in the near term? Hopefully the geopolitical risks will go away, but are we sort of in a good space even today? I think the same question is for you as well.
So I think we all have done a great job in last when the pandemic did, right? And now, of course, we have another geopolitical problem. But let's be very clear, while we would like to say we did a great job, but it's the central bank, right? And not because they are here, but I genuinely believe markets can function functionally very well in a normal times, right? When there are external events, when there are, shocks and the extremes, right? It is the central bank who needs to guide and set the parameters. And that's what I think last time central bank did pretty well. And I see no reason why even this year they won't do it, right? So I think I'm quite confident that they will do it. So they will draw the casting line and they will draw the parameter. And then of course, markets manages within parameters, but if it is beyond that parameter, then it has to be central bank. So
Sure.
I am a firm believer in that.
Sure. Anita, your views?
Yeah, so I think, I echo, Jayesh's comment. We've seen markets very orderly. There have been certain things, right? You've seen a huge amount of liquidity coming through, right? Liquidity is increased. Even today you see 5 lakh, 6 lakh crores are daily in terms of the liquidity things. We've had very benign interest rate environment in the last 2 years, obviously because of the pandemic and because of the central bank's action and the support to this thing. We've seen the equity market, the best performing equity market in the last, in at least a year out of those 2 years in COVID, India was the best performing equity market thing, right? So all of this, I think for the first time actually led also to a kind of a very, very stable currency strength. So you've not again used, we've been seeing rupee with this mild depreciation, I think a place which a lot of people don't disagree or don't dislike particularly. And we've not seen that. We've seen a very strong currency. So yes, markets have been behaved, but then I don't think as a market, something special or particular was done for COVID. I think this is an amalgamation of how regulation is done in India and how the interaction between the regulator and the market participants happens pre-COVID, during COVID and post-COVID as well. So I think the challenges are more today actually from a financial market perspective, because obviously there is questions around interest rate hikes, there's inflationary pressure. I don't think we are anywhere close to stagflation, by the way, but 6% CPI is not the end of the world from an India perspective. But the pressures are more. The pressures are more from a geopolitical thing, right? So the supply constraint that we all were hoping will resolve in 5-6 months are not going to resolve now in 5-6 months with with this prolonged Russia-Ukraine situation, and that has an impact, right? So I think the challenge for us to do what we've been doing so well will be there. The liquidity, how to manage liquidity and a depreciating currency, kind of a thing. So yeah, the challenges are there, but I think the confidence is also there that the markets will behave themselves. And we are seeing that confidence return back in a small measure through foreign investors today, right? So I again think that the 20-25 billion seeing that we saw money moving, leaving the country in the last, the selling in the equity market in the last 3 months, barring 1 week in March, we really didn't see a huge pressure on the rupee. And that week was on account of oil, on account of selling, etc. Right? So yeah, that's my view. Thank you.
Mr. Sinha, your view on- Will we sail to that?
We are doing all right so far.
Let's
Of
speak to
course,
that.
rupee has been depreciating except for last 1 week or so. There are risks of imported inflation that we all are very familiar with. Inflation is expected to inch up at least in the near term, 3, 4, 5 months. But, and of course, apart from that, geopolitical Fed is the major risk. Look at the positives that we have today. Look at the equity market, how it has behaved despite massive outflow. I think one of the highest or possibly the highest in last 10, 11 months in its entire history. Equity market. Look at the way, of course, with support from here and there, the rates market are reasonably well behaved, and foreign exchange we know. So we have huge forex reserve, 9 billion goes down in 1 year, and we say, okay, that is fine. We have 621 still left. And it's not going to continue. We talk about oil price, but if you look at the data, oil export has gone up by 33, oil import has gone up by maybe 60, 55, something like that. So it has both the sides to it. I believe that geopolitical risk, chances of escalations are there, but I would like to hope that it will linger around these levels for quite some time. Fed, first, they have already started the process. So we have a large, very high level of clarity on Fed and other central banks also. Look at India. If you look at the 4 measures of free, generally we pick up one of the measures. 4 measures of free, it's 98 to 102. I would like to think that rupee is fairly valued. So if rupee stays at around 76.5 and interest rate 10-year remains at 7, I would like to think that that is a great arbitrage opportunity for foreign investors also. I'm sure fixed income also would see whether indexation or not. Fixed income will see good amount of inflow this year. Equity, I would like to wait for some more time, but equity, domestic investors, SIP players, people like you and me, I think we are supporting very well. Rupee also, inflows and outflows, 2 days it goes to 76.90, and then we talk about, I talked to 2 dealers. One says that in 3 months time it will be 75, others say it's 77. I would like to think that rupee is fairly valued at this level. No uncertainty. Volatility, yes. It will create moments of anxiety for all of us, yes. But long-term risk, no. The only problem is that we'll have to manage imported inflation in the best possible manner. Look, food inflation doesn't affect India. It has not affected India. Food grains essentially for the last 5, 6, 7 years. Even when in September, October, it went up significantly. Sorghum went up by what, 80% or 100%, wheat by 40%. We were quite cool. Most of us actually never realized. So if we can manage imported inflation, if we can somehow manage gold import, I think we'll be good. Thank you.
Thank you. So it looks like we are in a good place. I know Mr. Pradhan has told me that we need to wind this up quickly, but looks like with the RBI sort of helping principle-based regulation, etc., we are going in the right direction. But 30 seconds from each one of you in terms of what's the next goalpost? What's the sort of wish list in terms of getting even more linked with the global financial markets? Starting with you, Jayesh.
So I think immediate wish list is the index, not for anything else. But as we go, I think it's about while we, as you said, convertibility is not part of this, but at least on the financial side, we can work. Why only IFC? Indian banks can actually do it from other branches, and therefore that will kind of get you the globalization of interlinkages of globalization. So that's something one can really look at it. So that's a little bit away, but yeah, we can think about it that any branch anywhere in the world, as long as we are backing out here, you can do it. So some part of it is allowed, but maybe we can see that in more products.
Sure.
And also it's also a little bit up to the participants also. The retail have taken the LRS very well. Institutions are also allowed to a certain extent, particularly mutual fund, insurance, to invest abroad. Of course, maybe they find Indian market more attractive, or maybe they understand the Indian market more, but that's not happened. At some point of time, that would also happen. And hopefully, like, arbitrage wise, it may sometime happen reverse. I would look forward to that, we may find Indian bonds not attractive, but the US bond more attractive in terms of yields.
Sure. Anita?
Yeah, so I'm not mentioning the same thing Jayesh has done, but I think we look forward to few things. I think more product development in the rupee derivative space, swaptions was one, seeing more two-way liquidity there, bond frost was another, seeing again more two-way liquidity there, and more product development. Just in fact, can we do a T-bill swap, curve, for example, etc. I think we can look forward to more on TRSs, so again, the SCRA, and will we see a change there that will allow us to do corporate bond TRSs. I, for one, am very hopeful and excited also to see how IFSC develops on the equity side, because I think there again lies a unique opportunity to provide direct market access to India, in dollarized form, that does away with things like swaps and P notes, and something that, neither SEBI or, Singh has been very comfortable with.
Sure.
So yeah, lots to look forward to.
Sure. And Mr. Sinha, your wish list?
Let us use
Yeah.
the time to strengthen our already very robust infrastructure. So for example, CCIL has promised us a very wonderful initiative. Can we, in the meantime, work on some sort of regulatory equivalence for our financial market infrastructure that will take care of operability between two payment settlement system? That will be again a game changer sort of thing. So all that we need to know is that CCIL is our counterparty, whether we are dealing in CDS or swaps or whatever. So that will be an ideal situation, and we have to work towards bringing in more and more. In fact, all the banks in this story, so far as interlinkages are concerned. So we have to enable them. Tri-party collateral management system, if necessary, we can think of. I think we have been discussing this thing with the various market participants for quite some time. So these are some of my wishes.
Sure, sir. And last one for you, Mr. Nath. You've heard from the market in terms of a general wish list. Any comments?
As I have already stated earlier, and Indices also had stated, we have a principles-based regulatory regime where we have already said that the goal is that any person who wants to access financial market should be able to do so with minimum cost and maximum ease. So as long as obviously they are in sync with the capital account regime of the day, as well as prudential norms. So we are okay with, and the wish list is for the markets to, or for the bankers to articulate, and I'm sure they are in formal as well as informal dialogue with the Reserve Bank also.
Absolutely. Thank you so much, sir, all of you. I don't think we have time for questions, right? One, maybe if the audience has one.
My colleagues are standing at the back. Whoever wants to ask a question, so please raise your hand so my colleagues will come and give the mic. Here, Dinesh in the front. We'll take maybe 2-3 questions.
Yeah, thank you very much for that lively discussion. I wanted to ask something around bond indices, but since much has been spoken about, and I take it that as Mr. Rajesh Sinha says, that even if it is not included, the markets will still run. There may be volatility, but will continue. So I take it as we take it, though of course it's a great enabler. I take it that it's a work in process, as told by Mr. Saurabh Nath. My next question is to the other market participants that we have been moving towards, or we have already moved partially towards the T+1 settlement in the equity market. Since it's mostly Mr. Jayesh Mehta Anita Mishra can just see. What about the initial reaction about the offshore customers? Are we really prepared? Have we for this T+1 settlement, or there's still much to do as far as infrastructure regulations and other things? Not regulations, it's infrastructure, other things to concern. My second question, if I am allowed to do so, is that FOMC has increased the rate of interest. There is a inverted, there is an inverted yield curve or between 5 and 10-year US Treasury yields. How would you see the bond yields on Monday starting? I mean, once the, because there's a rate increase of FOMC, there's an yield, the 10-year Treasury has gotten up to 2.21, and there's an inverted yield curve of 5-year and 10-year in US Treasury. Any views on the market, bond yields?
Can you just keep the mic a bit
Yeah.
away from your
Yeah.
mouth? Yeah, now can
T+1 equity settlement. That is what I asked, that whether we are ready for, I mean, we've already gone into it, and
For the global customers who are trading in India. I think that's the question, sir.
So it's of course equity is outside my realm. So, but I will still add them. It's a personal view and not the organization view. It's more like we really don't know, because I don't think global investors are really looking at T+1, but our regulators have gone ahead to work for T+1. And for that, there's of course definitely asked from the market players to extend the market timings and stuff like that. How much is it practical to do? That's a question mark that we need to see how it works. Of course, we are allowed 24/7 market, but you know, for T+1, custodian bank would own market beyond 5 p.m. to 8 p.m. and stuff like that. Look at practicality of it. Corporate's not going to extend their working hours. So there's going to be some challenges there, but let's see how it works further. Maybe some margining kind of thing, T-1 margining or some sort of things, or maybe the custodian bank will have to warehouse the risk. I really don't know what is the solution to it, but yes, even the regulators, the equity regulator is also going slowly. So let's see how it pans out, and once it gets more volume, then we see how it's going to affect or disturb the market.
Thank you. Yeah. No. That's okay. What are the second questions, sir?
market bond, because
Your question was US going up, how are we going to react? That was the question. Yeah, so, well, I think at this juncture, my view on the market is whatever is happening globally is all transitory. I think April, May, June, July is where we will see where the RBI draws the casting line. For us, that is important. And once they draw the casting line, that will change the thing. Because, I am not a believer of that just because US is raising rates, we need to raise rates. Just because US inflation is high. If you look at it, their target is 2%. They are at 7.5% inflation. Ours is 2 to 6%. And except for this Ukraine thing, and not even oil, I'm not too worried about oil. Oil is now back to kind of getting settled, but it is more about the other commodities. But even with that, we have to see how much extra we are going. Like if you look at second quarter forecast from Reserve Bank is fourth quarter. Now, fourth quarter, is it really going beyond 6? Then it's a different story. If it's not going beyond 6, it's fine. We don't need to be just moving because US is moving. But yes, in the interim, right now, it's very, I would say, a transition market, because the real thing will come when the supply starts in April, right? So for us, that would be the more bigger trigger than the US rate going up. Yes, it will have some little bit of impact immediately on Monday, but nothing major.
thank you.
Thank you. I think we can end with this.
Okay. So we are going to end this here.
Yeah.
There's a bowl with my colleague there. If I'm sorry, earlier I mentioned State Bank of India. It's a world by Fedai. And if anybody still hasn't dropped his card and wants to drop his card, this is the last call for that. In the meantime, I request my Chief Executive, Mr. Sindhwani, to please come and give the mementos. No, everything is by SBI. SBI, everything is by Fedai. Let me clarify. My colleagues in Fedai have vociferously objected, saying, "What SBI? This is by Fedai."
No, no, like we say that State Bank never gets out of your mind.
True, true. I admit to it.
You
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 can't take
mentioned
State
the
Bank
State
out
Bank
of
of
it.
India. So thank you very much. It's really a privilege and pleasure to be here today and to be invited to hand over the mementos to this August gathering over here to all these dignitaries. But I would like to share that pleasure with the participants over here. So what I'm going to do is that get that bowl over here, request you to pick up just one card from that. And whosoever is that lucky person, maybe I'll request them to hand over the memento to you. And in return, we'll try to give some gift to them as well.
Looks good. Sounds good.
Earlier we used to conduct that quiz over here. Whosoever gives the right answer will get the prize. But then I realized we were giving the prize not to the smartest mind, but to the fastest fingers. I think we should get the bowl over here now. So in case anybody has missed out, maybe we'll have one more round for this later. So we have covered the bowl just to say that it's totally non-transparent. So Mr. Rajay, please. No, this is disqualified. Disqualified. It's his own card. It's his own card. I hope it was not just like a magician having your own card in the hand and then picking it up.
Oh.
Okay, it's Mr. R. Janki Raman from SVC Cooperative Bank Limited. In the meanwhile, maybe we can pick up the other name also.
Mr. Vaibhav Thabapurkar, yes, ma'am.
Janki, you have to wait. You will also get this. Mr. Vaibhav. Vaibhav, okay. One more from SVC Cooperative Bank. Manjunath Kamath.
This is Seema Ganpati, Senior Manager, CCR.
Akshay Raj, Karnataka Bank.
you all. And I don't think anybody can say Fedai doesn't try and do new things. So we did try something new this time. So now we'll break for lunch. Lunch is 1 hour, 15 minutes. So lunch is here itself. So please join all of you, please join us for lunch. Thank you.